Look at the front page of basically any financial paper today, and you are almost guaranteed to see some variation of the exact same gloomy narrative.
Oh, absolutely. The doom and gloom about the global energy transition.
Right, exactly. The headlines just scream that electric vehicle demand has hit a wall, that the consumer has completely rejected the transition, and that the heavy materials supercycle as well, that it's effectively dead.
Yeah, but I mean, when you actually bypass the editorial pages and look at the physical flow of heavy materials, it's a completely different reality.
It really is. Like, while U.S. vehicle unit sales might be sluggish right now, total global demand for battery capacity actually quietly grew by 3% this past quarter.
And that disconnect is just staggering to me. I mean, between the popular narrative and the physical reality, people are totally conflating a regional slowdown in, entry-level automotive sales with this massive global structural shift in industrial power consumption.
Right, they're just looking at their neighbor's driveway.
Exactly. If you only look at the consumer driveway, you completely miss the Chinese subsidy policies mandating these massive battery scale-ups. And you also completely overlook the explosion in utility-scale energy storage.
Which is completely necessary right now to keep all these artificial intelligence data centers online.
Exactly.
So that friction point between the media narrative and the raw, unforgiving data that is our mandate for today, we are doing a deep dive, taking the talk tickers approach and applying a massive magnifying glass to Albemarle Corporation's Q1 2026 earnings call.
Looking at the ticker ALB.
Right. And our objective here is to cut straight through the Wall Street jargon, pull out the hard metrics, and take a really firm, opinionated position on how this company is actually performing under the hood.
Because we want to break down actionable insights for you, the retail investor, who is just trying to navigate this incredibly murky lithium landscape.
Yeah, we are expanding our usual punchy data-forward style into an exhaustive breakdown of the actual mechanisms driving this business.
I mean, we really need to dissect the mechanics driving their cash flow, right? And test the reality of their forward guidance and map out these structural shifts in global demand. It is simply not enough to know that a metric went up or down.
Right. You have to know why.
Yeah, we have to understand the geopolitical weather, the chemical supply chains, the inventory time lags, and the highly physical reality of pulling critical minerals out of the earth.
Okay, let's unpack this, starting with the Q1 headline numbers, because honestly, on the surface, these figures look like they belong to like a high-growth software company, not a heavy industrial mining operation.
They really do.
Albemarle reported net sales of $1.4 billion, which represents this massive 33% increase year over year.
Just massive top-line growth.
Yeah, and diluted earnings per share came in at $2.34. And then we get to the adjusted EBITDA, which gave us a highly relatable, albeit slightly chaotic moment during the live call.
Oh, I loved that part.
Right. CEO Kent Masters was reading his prepared remarks and boldly stated that adjusted EBITDA was $664 million.
Yeah, and then a few minutes later, CFO Anil had to step in and gently correct the record.
Basically saying, actually, the number was $364 million.
I mean, a $300 million verbal stumble is certainly one way to wake up the analysts on the morning call.
Seriously. But even with the correction down to $364 million, the underlying growth story remains completely intact, because that $364 million figure is up $397 million from the prior year.
Right, which mathematically translates to an adjusted EBITDA margin that expanded by more than 20 percentage points year over year.
20 points.
Yeah, and they also generated $346 million in operating cash flow and $248 million in free cash flow. But I mean, for a retail investor trying to parse this, seeing a 20-point margin expansion in a manufacturing and mining business just seems almost counterintuitive.
It really does. It's an anomaly that requires us to look at how operational leverage actually functions in a heavy industrial setting.
Exactly. I mean, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It serves as this raw proxy for the operational profitability of the business before the capital structure and tax liabilities get factored in.
Right. It's a core engine.
Yeah. So when you see a heavy materials company expand its EBITDA margin by 20 points, you are witnessing the sheer force of fixed cost absorption.
So it's sort of similar to building a massive toll bridge, right? Like the initial capital expenditure to pour the concrete, secure the land rights, build the infrastructure, all of that is astronomical.
And massively expensive up front.
But once the bridge is open, the actual cost to allow the 1 millionth car to cross is practically zero.
Exactly. The revenue from that car flows almost entirely to the bottom line.
So that captures the dynamic perfectly.
It does. In Albemarle's case, their quote-unquote toll bridge consists of massive hard rock mines, evaporation ponds, and chemical conversion facilities. I mean, they have fixed labor costs, heavy machinery leases, baseline energy requirements just to keep the lights on.
Right, massive fixed overhead.
Yeah. But once those massive fixed costs are covered by the initial volume of lithium sold, well, every subsequent ton of lithium carbonate they push through the facility carries a phenomenally high profit margin.
Because the overhead is already paid for.
Exactly. So if market prices rise, or if they optimize their chemical processing to push, say, 15% more volume through the exact same fixed footprint, a vast majority of those new revenue dollars just drop straight down to the EBITDA line.
Okay, but I look at a massive margin expansion in Q1, and my immediate instinct is just pure skepticism.
Naturally.
We have to separate sustainable skill from temporary luck. I need to know if this margin expansion is the result of a structural improvement in their extraction technology, or maybe a permanent shift in market pricing, or, and this is the big one, if they simply benefited from a temporary inventory accounting quirk that is just going to vanish by Q2.
That is the million-dollar question, or, well, the $397 million question. And to separate the signal from the noise, we really have to look past the consolidated headline numbers and examine the localized environments of their specific business segments.
Because the consolidated EBITDA doesn't tell us how they made the money.
Right. For that, we have to turn to their two primary operational engines, the energy storage segment, which houses the lithium business, and then their specialties segment.
Okay, let's start with energy storage. The raw data shows that pricing jumped 51% and volumes increased 14%.
Which sounds fantastic.
It does, but reading through the transcript, the jargon immediately obscures the reality of those price increases. They noted that their average realized price was $17 per kilogram for LCE, or lithium carbonate equivalent.
Yep.
But if you cross-reference that with the spot market pricing discussed later during the analyst Q&A, Chinese spot prices for lithium were actually hovering near $27 per kilogram during that exact same period.
A pretty massive gap.
Huge. If I am holding the stock, I am immediately asking why the sales team is seemingly leaving $10 a kilogram on the table. Like, are they just locked into terrible legacy contracts?
Well, no. I mean, the gap between the $17 realized price and the $27 spot market price is not a failure of negotiation. It is a mechanical byproduct of how industrial commodities are contracted and physically blended.
Okay, so it's a structural thing.
Yes. The CFO outlined two very specific factors dragging that average realized price down. The first factor is the structural pricing lag embedded in their long-term customer contracts.
Walk me through the mechanics of that lag. How does a quarter-old price dictate today's revenue?
So Albemarle does not operate like a day trader, just dumping their daily lithium production onto the open spot market to whatever buyer happens to be bidding the highest that morning.
Right, because that would be chaos.
Absolute chaos. That strategy would introduce catastrophic volatility into their revenue streams, and it would completely alienate battery manufacturers who require guaranteed, predictable supply chains to run their gigafactories.
Yeah, Ford can't just hope the lithium is cheap on a Tuesday.
Exactly. So to solve for this, they utilize long-term supply agreements. Roughly 40% of Albemarle's total volume is tethered to these specific contracts.
And these contracts don't use a fixed price, right? They use a trailing average.
Yes. The contracts typically utilize a 3-month or 1-quarter trailing average of index prices to smooth out extreme market volatility. It basically acts as a financial shock absorber.
Okay, I see.
It means that the price Albemarle is actively charging its contracted customers in Q1 is heavily anchored to the actual market prices from Q4 of the previous year.
So if the spot market suddenly spikes in February, Albemarle's contracted revenue will not fully reflect that spike until the formula is reset in the subsequent quarter.
Right. They're perpetually operating on a 3-month delay.
Which explains part of the drag. The spot market ran up to $27, but Albemarle is still fulfilling massive volume orders based on the cooler prices from 3 months prior.
Exactly.
But wait, that lag doesn't fully explain a drop all the way down to $17.
Yeah.
There has to be a physical component dragging that average down as well.
There is. And the physical component dragging the average down is the direct sale of spodumene.
Spodumene being the raw, lithium-bearing hard rock pulled directly out of the ground in places like Western Australia.
Correct. So the traditional value chain involves mining the spodumene, crushing it, and then shipping it to a massive chemical conversion facility.
Right.
At the conversion facility, it undergoes intensive roasting and leaching to be refined into a highly pure white powder, either lithium carbonate or lithium hydroxide. And that is the final high-value product demanded by battery manufacturers.
The battery-grade stuff.
Right. However, Albemarle does not refine 100% of the spodumene they mine. Sometimes they sell the raw, unrefined spodumene concentrate directly to third-party processors.
And because it's an unrefined raw material, it obviously commands a drastically lower price per ton than the finished battery-grade chemical.
Yes, but here is where the reporting mechanics create the confusion. When Albemarle reports their total volume and pricing to Wall Street, they convert all of their sales into a standardized metric called LCE, or lithium carbonate equivalent.
Okay.
They mathematically convert the raw rock sales into the equivalent amount of finished powder it would have been.
Oh, I get it. It's the equivalent of like a coffee distributor reporting their average price per pound of coffee sold. But they're blending the sales of dirt cheap, unroasted green beans with the sales of ultra premium, small batch, dark roast.
That is a brilliant analogy.
Right. By blending the two distinct products into one unified average price per pound metric, the massive volume of cheap green beans mathematically dilutes the reported average, even if the dark roast is selling at record highs.
That analogy perfectly isolates the math. When you combine the mathematical dilution of raw spodumene sales with the contractual time lag keeping 40% of their volume tethered to Q4 prices, you arrive at that $17 per kilogram realized price, despite the spot market flashing $27.
Wow. But uncovering that math leads us directly into a massive margin mystery.
How so?
Because if their realized price was artificially dragged down to $17, how did the energy storage EBITDA nearly triple? The data shows a 196% increase in profit.
Right.
You just do not get a 196% profit increase when your primary pricing mechanism is lagging the broader market. There has to be a cost side variable driving that margin.
And the cost side variable is exactly where we find the temporary inventory look we were looking for earlier.
Okay, here we go.
The massive margin expansion in Q1 was heavily subsidized by an accounting illusion related to inventory timing.
Break down the timeline on that. How does inventory timing artificially inflate quarterly profit?
Well, it requires understanding the physical transit time of heavy materials. When Albemarle blasts spodumene out of the pit at their Greenbushes mine in Australia, it doesn't instantly become revenue.
Obviously not.
It gets mined, stockpiled, loaded onto bulk carrier ships, transported to Asia, unloaded, and then run through chemical conversion facilities. That entire physical journey takes months.
So the lithium carbonate they actually sold to customers in Q1 was manufactured from spodumene that was physically mined back in Q4.
Exactly. From an accounting perspective, the cost of goods sold reported in Q1 is directly tied to the cost of extracting that specific batch of spodumene back in Q4.
Right.
And crucially, the overall cost to mine and produce that spodumene in Q4 was unusually low. So when Q1 rolled around, they recognized sales revenue that had jumped 51%, but they matched that revenue against the artificially cheap raw material costs from Q4.
Oh, wow. They bought the raw ingredients at a massive discount last quarter, but they got to sell the fully baked cake at a premium this quarter.
That's exactly it.
The gap between the cheap historical cost and the elevated current sale price widened dramatically, printing a massive but ultimately temporary profit margin.
And this is not some hidden flaw, you know. Management was completely transparent about the mechanics. The CFO explicitly stated that the EBITDA margins in the energy storage segment will face sequential compression as they move into Q2.
Right, because the cheap stuff is gone.
Exactly. That cheap Q4 spodumene inventory has been fully consumed. Starting in Q2, they have to start recognizing the costs of the spodumene they are mining now, which is more expensive.
So the lithium narrative is basically a strong quarter, heavily boosted by a temporary inventory tailwind that is absolutely guaranteed to fade.
Yes.
And if that tailwind is fading, they need a shock absorber elsewhere in the business.
Yeah.
And looking at the operational breakdown, it seems they found it in the specialties segment.
A hidden gem.
Right. Sales here were up 12% year over year, and EBITDA was up an impressive 30%. Everyone treats Albemarle as a pure play lithium stock, but this segment is doing serious heavy lifting. What is the physical product actually driving this?
The specialties segment is predominantly driven by bromine and bromine derivatives.
Bromine.
Yeah. While lithium captures all the geopolitical headlines, bromine is a quietly essential chemical used in a vast array of industrial applications. I mean, it is used heavily as a flame retardant in consumer electronics and construction materials.
Okay, that makes sense.
But a significant driver of their recent margin expansion involves clear brine fluids, which are absolutely critical for the oil and gas drilling industry.
Now, CEO Kent Masters made a point to highlight this macro shift. He noted that even though oil and gas applications represent less than 5% of their total net sales, they are seeing strong near-term demand specifically because global drilling operations are migrating.
And they are migrating because of the geopolitical instability in the Middle East. It is forcing major oil and gas producers to aggressively pivot their capital expenditures and exploration activities toward more stable geographies.
Oh, I see.
As these deep water and complex drilling operations spin up in new regions, they require massive volumes of clear brine fluids to manage well pressure and lubricate the drill bits. Albemarle's global footprint allows them to capture that migrating demand effortlessly.
Beyond the macro demand, there is also a localized recovery story here, right? What drove the 30% jump in profit for this specific quarter was the stabilization of their Jordan Bromine Company joint venture.
Yeah, that was huge. That facility suffered a catastrophic flooding event in late December of 2025. It severely disrupted production and dragged down the segment's efficiency metric.
Just a terrible event.
So the 30% EBITDA jump in Q1 of 2026 is largely a reflection of that joint venture finally returning to full operational capacity. They've fully recovered from the flood damage, optimized the facility, and are running at high utilization rates despite the surrounding regional tensions.
Well, wiping out an operational bottleneck in specialties is great, but wiping out $1.3 billion in corporate debt is what actually alters the fundamental risk profile of the company.
Oh, without a doubt.
We have to discuss the balance sheet maneuvering here because they essentially bulletproofed the company this quarter.
The debt repayment is arguably the most crucial long-term takeaway from this entire earnings call.
The raw data is that Albemarle retired $1.3 billion in debt in a single quarter. But they didn't achieve this by, draining their operational cash flow or cutting their capital expenditure budgets.
No, not at all.
They funded the repayment entirely through strategic divestitures. They sold their Eurocat joint venture and divested a controlling stake in a subsidiary called Ketjen. I mean, converting non-core assets into debt reduction in a high interest rate environment is just a textbook capital allocation masterclass.
It really is. By extinguishing that $1.3 billion liability, they drastically reduced their weighted average interest rate across the entire corporate structure down to just 3.1%.
Wow. 3.1% in this environment.
Yeah. And the mathematical reality of that move is that it eliminates approximately $60 million in annual interest expense.
That's incredible.
That is $60 million of pure cash flow that is no longer being vaporized by bank interest, but is instead retained within the business.
And it brings their net debt to EBITDA leverage ratio down to 1x. I mean, for a retail investor trying to understand leverage risk in the mining sector, 1x is almost unheard of.
Because mining is an intensely cyclical, capital-heavy industry. When the commodity cycle inevitably enters a deep trough, the companies that face insolvency are rarely the ones with poor geological assets.
Right, it's the ones who overborrowed.
Exactly. They're the ones who took on 4x or 5x leverage during the peak and suddenly find their cash flow cannot cover their massive interest obligations. By dropping their leverage down to 1x, Albemarle has built a literal fortress balance sheet.
And more importantly, they cleared the runway completely. From a debt maturity standpoint, they have no major balloon payments or forced refinancings due until late 2028. They have completely insulated themselves from credit market volatility for the next 2.5 years.
And they fortified the balance sheet just in time. Because when we shift our focus from the rearview mirror of Q1 to the forward-looking windshield of management guidance, it becomes clear they're going to need every ounce of that financial flexibility.
Oh, yeah. They are staring down a localized, highly destructive supply chain shock.
A huge one.
Management dropped a massive caveat into their forward guidance. They're projecting a $70 to $90 million unmitigated full-year cost impact due to global supply chain disruptions.
Yep.
And during the Q&A session, Eric Norris, the chief commercial officer, traced this $90 million hit directly to the rising costs of sulfuric acid for their Asian processing facilities, which was triggered by instability in the Middle East.
Right.
I really need you to break down the physical mechanics of this. How does a conflict in the Middle East instantly make lithium processing in China $90 million more expensive?
It is a brilliant case study in the hidden fragility of global chemical supply chains. To understand the $90 million hit, you have to understand the chemistry of acid roasting. When Albemarle ships their raw hard rock spodumene to a conversion facility in Asia, that rock has to be physically broken down to extract the lithium molecules trapped inside.
Makes sense.
The primary method for doing this involves crushing the rock and baking it in massive kilns with highly concentrated sulfuric acid. The acid basically leaches the lithium out of the waste material,
Which requires an astronomical volume of acid operating at industrial scale.
a staggering volume. And the foundational ingredient for sulfuric acid is elemental sulfur. The vast majority of the world's elemental sulfur is generated as a byproduct of oil and gas refining.
Wait, really? As a byproduct?
Yes. When crude oil is pulled out of the ground, it is often quote-unquote sour, meaning it contains high levels of sulfur. Refineries use a process called hydrodesulfurization to strip that sulfur out before the oil can be turned into clean gasoline or diesel.
So massive piles of elemental sulfur just accumulate at refineries, particularly, I imagine, the massive refinery complexes operating in the Middle East.
Exactly. The Middle East is the epicenter of global sulfur production. That sulfur is then loaded onto bulk carrier ships and transported through major shipping lanes to chemical producers in Asia, who convert it into the sulfuric acid needed by Albemarle's lithium conversion facilities.
Okay, the picture's coming together.
Right, so when geopolitical tensions in the Middle East disrupt those shipping lanes, whether through the threat of kinetic action against cargo ships or the rerouting of vessels around massive geographic choke points, the logistical cost of moving that sulfur skyrockets.
The cost of freight insurance explodes, the transit times double, and the spot price of sulfur in Asia instantly spikes.
Exactly. The Chinese conversion facilities suddenly face massive premiums for their most critical consumable chemical. And because Albemarle utilizes these facilities, those elevated processing costs are passed directly up the chain, manifesting as a $90 million hit to Albemarle's projected full-year operating costs.
Man, for the vast majority of mid-cap industrial companies, an unexpected $90 million supply chain hit would immediately trigger a downward revision of their full-year earnings guidance.
Oh, the stock would absolutely tank.
The stock would take a massive beating as analysts model the margin contraction. Yeah. But Albemarle did not lower their corporate guidance. They absorbed the blow entirely.
And this is where the balance sheet masterstroke we discussed earlier pays immediate dividends.
Right.
The strategic decision to divest non-core assets and retire $1.3 billion in debt resulted in $60 million of pure annual interest savings. That $60 million in structural savings immediately offsets 2/3 of the $90 million sulfuric acid shock.
That's incredible. The debt paydown effectively pre-funded the supply chain crisis.
Yep.
And the remaining $30 million gap is easily absorbed by the overperformance of the specialty segment. In fact, the specialties unit is performing so well that management actually raised the full-year guidance for that specific segment.
It did.
They're now projecting specialties net sales to hit between $1.3 billion and $1.5 billion, with adjusted EBITDA pushing up to between $225 and $275 million.
So specialties is acting as the ultimate operational shock absorber here. They raised the guidance there, but it is critical to note that for the energy storage segment, the core lithium business full-year volume guidance remains completely flat.
Flat for the year.
Yes. The massive Q1 margin beats in lithium are absolutely not carrying forward into the rest of the year.
We really have to underline the Q2 warning for you listening. The CFO explicitly stated it on the call. Q2 EBITDA margins for energy storage will drop sequentially.
It's coming.
The cheap Q4 spodumene inventory that artificially inflated the Q1 numbers is gone. The long-term contract lag is going to catch up to the pricing metrics, and that $90 million sulfuric acid premium is going to start bleeding into the cost of goods sold. The near-term reality is sequential margin compression.
The immediate quarter will definitely be challenging from a margin perspective. But, pulling back from the month-to-month accounting mechanics, the most compelling segment of this entire earnings call was management's commentary on the global end markets driving long-term demand.
Yes, the macro picture.
Because the financial press has absolutely saturated the market with an overwhelmingly bearish narrative regarding the death of the electric vehicle transition.
The prevailing wisdom is that because Ford and GM are scaling back their EV production targets in the US, the global transition is basically stalled.
Right?
But Kent Masters addressed this head on. He acknowledged the localized weakness in the US market, which is driven by consumer hesitation and reduced government incentives. But he followed that up with a statistic that completely shatters the North American bias. He noted that the US EV market now represents less than 10% of total global EV demand.
It is a vital reality check. Retail investors so often fall victim to home country bias. We look at the car dealerships in our own zip codes and assume that local inventory reflects the global macroeconomic reality.
If your neighbors are buying hybrid trucks instead of full EVs, the assumption is just that the revolution is over.
Exactly. But the data from Albemarle completely contradicts that. While the U.S. market lags, developing economies are accelerating rapidly. They reported that markets in Brazil, India, and Australia collectively grew their EV adoption by an astounding 74% year over year.
74%.
The demand is geographically diversifying away from early adopters and penetrating massive emerging markets.
Yet, even with that 74% growth in emerging markets, the global baseline data still show that overall EV unit sales, the sheer number of cars rolling off assembly lines worldwide, dropped by 6%. The bears point to that 6% drop in unit sales as absolute proof of demand destruction.
But this is the critical nuance that changes everything. Global unit sales dropped 6%, but total gigawatt-hour demand for lithium batteries actually grew by 3%.
Okay, how do you mathematically achieve higher battery demand when fewer cars are actually being built?
It is the result of a massive structural shift in Chinese government policy. In 2026, Chinese regulators drastically altered their EV subsidy programs. They pulled financial support away from entry-level, low-range commuter vehicles and heavily redirected those subsidies toward premium vehicle segments.
And when you incentivize premium vehicles, you are incentivizing range.
Yes.
Consumers buying premium EVs demand the ability to drive 400 miles on a single charge without suffering range anxiety.
And to deliver that range, the physical battery pack has to be larger and more energy dense. Albemarle reported that as a direct result of this subsidy shift, the average size of an EV battery in China increased by 20% in the first quarter alone.
That dynamic is fascinating. Albemarle does not care how many steering wheels or chassis are sold. They are a chemical company. They sell their product by the kilogram.
Exactly.
If a Chinese automaker builds 6% fewer cars, but crams 20% more lithium carbonate into the floorboards of the cars they do build, the net demand for Albemarle's product increases. The pivot to larger batteries completely neutralizes the drop in top-line vehicle unit sales.
It perfectly highlights why relying on traditional automotive metrics is incredibly dangerous when analyzing a heavy materials company. But honestly, even more impactful than the shift in battery size is the absolute explosion in demand from a completely different sector.
ESS.
Yes, ESS, or energy storage systems. The demand in this category didn't just grow. It skyrocketed by a staggering 117% in Q1.
117% jump in a single quarter is just parabolic. And we are not talking about residential consumers putting small battery packs in their garages to run their lights during a thunderstorm. This is infrastructure scale deployment.
This is utility scale demand driven by two overwhelming macroeconomic forces. The first force is grid reliability. As global energy grids integrate higher percentages of intermittent renewable power like wind and solar, they face massive instability.
Because the sun goes down.
Right. Solar panels produce peak energy at noon, but peak consumer demand hits at 7 p.m. when people return home. To bridge that gap, utility companies are deploying massive, acres-wide lithium-ion battery parks. These systems absorb the excess generation during the day and discharge it into the grid at night.
That explains the baseline growth in ESS. But the explosive 117% spike is being catalyzed by the second force, artificial intelligence.
The sheer physics of the AI revolution are colliding with the limitations of the public power grid. Training and running massive large language models requires hyperscale data centers that consume electricity at a terrifying rate.
Just massive power draws.
The cooling systems in GPU clusters draw so much continuous power that local municipal grids simply cannot guarantee stable delivery.
And if an AI server farm loses power for even a fraction of a second, the compute cycle is interrupted, and millions of dollars in processing time are instantly vaporized. Tech companies cannot afford that latency or instability.
Exactly. So to guarantee 100% uptime, these massive tech conglomerates are being forced to build behind-the-meter energy storage. They are constructing dedicated, industrial-scale lithium battery facilities on-site at the data centers.
Like their own personal power plants.
Basically. These batteries sit between the data center and the public grid, acting as a massive, uninterruptible power supply. This AI-driven infrastructure boom is acting as a backdoor catalyst for colossal lithium demand, and it operates completely independently of whether consumers are buying electric cars.
So the ESS growth is completely offsetting the EV sluggishness. It fundamentally changes the narrative of what lithium is actually used for.
It really does.
But servicing this massive new AI and grid demand requires pulling millions of tons of rock out of the earth. Which brings us to the operational reality of mining and a specific issue they flagged regarding their CapEx guidance.
Yeah, the mining side of things.
They are maintaining a massive $550 to $600 million capital expenditure budget. But during the call, they noted that at their Wajana joint venture mine, the ore quality is actively going to drop for the next 2 quarters before rebounding late in the year. How does ore quality just drop, and what are the financial implications of that?
It is a reminder that mining is a physical battle against geology, not a software program.
Right.
The concentration of lithium within the Earth's crust is simply not uniform. At the Wajana mine, they are currently expanding operations by digging deeper into what they call the Stage 3 pit. As they excavate this specific section of the resource body, they are hitting a zone of lower-grade ore.
Meaning the ratio of valuable lithium to useless waste rock is lower.
Precisely. And when the ore grade drops, the operational efficiency of the entire mine plummets. To extract the exact same amount of finished lithium, you have to blast, load, haul, and crush significantly more raw rock.
So more diesel, more electricity.
Yes. The heavy machinery burns more diesel, the crushers consume more electricity, and the wear and tear on the equipment accelerates. It drives up the cost per ton dramatically.
Okay, but it's temporary.
Yes. They have extensive core sampling data showing that this low-grade zone is temporary. As they push deeper into the pit by Q4, they will intercept higher-grade ore and the efficiency metrics will rebound.
Geology is unpredictable, and fluctuating ore grades are a standard operational hurdle. But the human dynamics of joint ventures are far more volatile, and this earnings call featured some highly public friction regarding their other massive asset.
Yeah.
The Greenbushes mine in Australia.
The Greenbushes drama, that was definitely the elephant in the room during the analyst Q&A.
Oh, yeah. An analyst from BMO Capital directly confronted CEO Kent Masters regarding highly publicized complaints from one of Albemarle's joint venture partners at Greenbushes, a company called Talison. Talison had recently gone to the financial press and publicly criticized the mine's safety record, citing issues with extraction recoveries and questioning the overall production stability. They essentially aired dirty laundry on a global stage, implying systemic mismanagement.
Which is pretty unheard of.
Right. And Albemarle used this earnings call to firmly counter those claims, stating unequivocally that the mine is operating strictly to plan.
I mean, this kind of public proxy war between multi-billion-dollar JV partners is extremely rare, and it absolutely demands scrutiny.
If I'm a retail investor and I see 2 partners in a massive Tier 1 asset publicly contradicting each other in the press, my red flag radar is screaming. Should investors view this public friction as a sign of deep operational rot?
It is a red flag that warrants monitoring, but we really have to analyze the underlying motives and the defensive positioning management took. Kent Masters was diplomatically evasive when asked to guess why Talison went to the press, but he was ironclad on the data. He reiterated that the new massive expansion at the site, known as CGP3, is ramping up exactly on schedule, and that the total output is hitting Albemarle's internal risk-adjusted forecasts.
So if the production data is actually solid, why is the partner screaming to the press about instability?
Because joint ventures in the mining sector are incredibly complex ecosystems where partners rarely share identical downstream interests. Albemarle is an integrated producer. They are the primary customer of the spodumene produced at Greenbushes.
Oh, they use it themselves?
Exactly. They rely on that mine to feed their global network of chemical conversion facilities. They prioritize stable, predictable output volumes. Their partner, however, might be facing entirely different macro pressures.
Like what?
They might have divergent views on dividend payout policies. They might be facing internal liquidity crunches, or they might want to aggressively push production volumes beyond the current capital expenditure plan to capitalize on near-term spot prices.
So going to the press with safety and stability complaints is just a pressure tactic.
Largely, yes.
It is a highly aggressive negotiating maneuver designed to force Albemarle's hand regarding future capital allocation, transfer pricing, or operational control at the mine level.
Exactly. Masters acknowledge that safety is an ongoing priority and that they are implementing long-term cultural improvements at the site. But from a purely financial and production standpoint, Albemarle has completely factored this JV friction into their guidance. They view it as a political reality of operating a complex industrial asset, not a fundamental threat to the lithium supply chain.
Which brings us to the ultimate question. We have unpacked the massive Q1 margin beats, the temporary inventory illusions, the $90 million Middle East supply chain shock, the exploding AI data center demand, and the proxy wars at Greenbushes.
We've covered a lot of ground.
We have. And now it is time to synthesize this data into a definitive position. For you listening, holding or considering acquiring shares of the ticker ALB, what is the bottom line? Are we taking a bullish or bearish stance based on this specific earnings print?
When you weigh the underlying mechanics against the current valuation, I take a cautiously bullish stance for the long-term, multi-year holder.
Okay, why long-term bullish?
The rationale is firmly grounded in how this management team is executing on the variables they can actually control. Albemarle cannot dictate the spot price of lithium in China. They cannot resolve geopolitical conflicts in the Middle East, and they cannot force American consumers to buy EVs. But they have absolute control over their balance sheet and their internal operational efficiency.
And executed flawlessly on the balance sheet.
They executed an absolute masterclass in risk mitigation. By ruthlessly divesting non-core assets to wipe out $1.3 billion in debt, they reduced their leverage to 1x and cleared all major debt maturities until late 2028. That single maneuver guarantees their survival through a prolonged commodity trough and gives them the structural flexibility to acquire distressed assets if competitors begin to default. Furthermore, their operational discipline is evident in their productivity initiatives. They have already locked in $40 million in process savings this year by debottlenecking their conversion facilities, and they are fully on track to achieve their $150 million annual savings target.
The ultimate proof of that resilience is their forward guidance. They absorbed a $90 million global supply chain shock without revising their corporate targets downward. That requires a highly durable business model.
It does, but that long-term bullish thesis comes with a severe near-term caveat for the short-term retail trader.
Which is the immediate reality of Q2.
Yes.
If you are looking at the Q1 earnings beat and contemplating mashing the buy button expecting a repeat performance next quarter, you need to brace for impact. The CFO explicitly warned that Q2 margin compression is coming.
It's mathematically guaranteed.
Right. The cheap Q4 spodumene inventory that artificially widened the profit margins in Q1 has been fully exhausted. The 3-month lag on their long-term contracts is going to drag on their realized pricing. And the massive spike in sulfuric acid costs is going to hit the cost of goods sold ledger aggressively. Very aggressively. The next earnings print is mathematically structured to look significantly worse than this one. For a short-term momentum trade, this is absolutely a hold, not a screaming buy.
That is a very pragmatic assessment of the near-term volatility. But if you are an investor willing to look past the Q2 compression and focus on a 3 to 5 year horizon, there is a massive, highly specific catalyst hidden in Albemarle's portfolio that absolutely demands your attention.
The domestic U.S. supply chain, specifically the Kings Mountain project in North Carolina.
Yes. For a long-term thesis, investors need to obsessively track the federal and state permitting process for the Kings Mountain mine, and they need to monitor the geopolitical shifts surrounding the NDAA, the National Defense Authorization Act.
An analyst brought this up during the call, pointing toward massive compliance deadlines hitting in 2028 regarding military procurement of critical minerals.
The geopolitical landscape is fracturing, and the U.S. government is aggressively weaponizing the Defense Production Act to decouple strategic infrastructure from Chinese supply chains.
Right. Bringing it all home.
By 2028, the Department of Defense, along with federally subsidized domestic EV manufacturers, will be mandated to source critical minerals exclusively from domestic operations or strict audited allies. Currently, Albemarle operates a brine extraction facility at Silver Peak in Nevada. Their plan is to take that lithium, alongside newly mined hard rock from North Carolina, and process it at a newly constructed state-of-the-art conversion facility at Kings Mountain.
This essentially creates a closed-loop, pure U.S.-based supply chain.
It creates the only fully domestic end-to-end lithium supply chain capable of operating at scale in the United States. While it represents a small volume of their overall global output today, it positions them perfectly for the future. If Albemarle executes a final investment decision to fully build out the Kings Mountain conversion facility, they will instantly become the premier, uncontested supplier for highly lucrative, incredibly secure U.S. military and federal infrastructure contracts.
They will essentially hold a monopoly on fully compliant, audited domestic lithium.
Yes.
And the broader market is currently too distracted by the month-to-month volatility of Chinese spot prices to price in the massive strategic moat that Kings Mountain represents.
Which is exactly why zooming out and understanding the physical realities of these supply chains is the only way to accurately value heavy materials companies.
That perfectly encapsulates our mission today. We always end these deep dives by giving you a final provocative thought to chew on as you review your own portfolio.
If we connect this entire discussion to the bigger picture, I want to leave you with a thought experiment based on the physical data we unpacked today.
Let's hear it.
Management confirmed that Chinese EV subsidies have structurally shifted, mandating premium vehicles that require battery packs that are 20% larger. Simultaneously, the artificial intelligence revolution is forcing the construction of behind-the-meter utility grids, driving a 117% increase in institutional demand for massive energy storage systems.
Both of these massive technological shifts require millions of tons of the exact same refined lithium molecules.
And neither of those shifts are slowing down. So here's the hanging question. What happens to the global lithium supply chain in 18 to 24 months when macroeconomic pressures ease, interest rates drop, and the massive mass market affordable EV sector finally rebounds?
Oh, wow.
What happens when millions of everyday consumers re-enter the car market and suddenly massive automotive OEMs have to compete in a brutal bidding war against multi-trillion-dollar AI companies and premium EV builders for the exact same finite supply of lithium carbonate?
That would be wild.
Given that it takes nearly a decade to permit and build a new hard rock mine, are we quietly sleepwalking into a catastrophic structural supply deficit by 2028?
A terrifying thought if you were a manufacturer, but a fascinating prospect if you are an investor. Are the tectonic plates winding up for a massive supply shock? You need to deeply consider that dynamic if you are holding this stock or watching the energy transition space. Look past the daily ticker tape, ignore the doom and gloom headlines, and think critically about the physical realities of the massive industrial machinery pulling these minerals out of the earth. Thank you for joining us on this deep dive. We'll see you next time.